Hey everybody, day 3 out of 5. Let's go. Today we're going to learn about the basics of life insurance. And this is a topic where people are like, why are you teaching high schoolers or college students about life insurance? Because I truly believe that it's never too early to be exposed to these kind of life topics, these adult life topics. So life insurance is one of them, and I just hope you can learn something from this. Uh, Thank you so much for watching this video. We are day 3 out of 5. So there's still 2 more days after this, and I hope you can join us for those two to get a whole picture of what insurance is like in life. Once again, there's a free note taker that I've created and a free certificate of completion that I'll be emailing hundreds of you who complete this course. Thank you so much for joining in, and honestly, I'd like to see so many people from all over the United States join in on this. It's been pretty awesome. That being said, if you'd like to support me and our channel, that would be awesome. If you have any Google account, it's free. You can just hit that subscribe button. That would really help, and or that thumbs up button if you like this content. All right. So without further ado, let's begin. So today we're going to learn about a few things. So number one, how to prepare your family financially for the future. What the definition of life insurance is, reasons why people get it, and types of life insurances that are out there, and how to obtain life insurance and how to save money. All right, so it's a lot. So here we go. Let's begin. How to prepare family financially for the future. I didn't plan to go into this, but last minute I added it. It's really about family planning when it comes to your assets. Right. So you've probably heard of a will. You've probably heard of a trust. So both of these are estate planning tools. And what's an estate? It's pretty much what you and your family have set up in terms of all of your assets, all of your valued assets in one place. That can help you ensure that your assets are protected and passed on to your heirs. So look, passing wealth to your surviving spouse is pretty easy because most things you co-sign and both of your names are on it. But passing wealth to your surviving children is actually kind of difficult, especially if you want to pass on the full amount and not get hit with that tax, right? But there's many different ways around it. So a will, let's start there. A will is a written document expressing a deceased person's wishes, from naming guardians of minor children to bequeathing objects and cash assets to friends, relatives, or charities. Now, a will becomes active only after one's death. All right. So if you are in the hospital and you need these things and these decisions being made, it's not going to happen because wills are only after someone passes away. A trust, on the other hand, is active the day you create it, and you can create a trust at any point in your life. And there's actually lawyers that actually only do trusts. And a grantor may list the distribution of assets before their death in it, unlike a will. So look, this is pretty in-depth here, and I feel like this is like adult lingo, but there's really two main types of trust that I've seen a lot. Now, once again, I worked 4 years at a bank before becoming a teacher, and I saw a lot of these trusts because the bank that I was working in was actually in a retirement community. The first type is called an irrevocable trust. Now, this is often created for tax purposes, to minimize taxes, to protect assets. And if it's irrevocable, then you cannot alter it after you create it. Once you create it, it's done. A living trust is something that can be changed by the grantor. Now, who's the grantor? It's whoever owns those assets and whatever you put into that trust. All right, so keep that in mind. Probate. This is like big lingo here when it comes to finances. Probate is the legal process that takes place after someone dies. It makes sure that property and possessions are given to the correct people and taxes, debts are paid in full. Now, this is usually done at the state level from what I've understood. And it's usually seen in like a negative light. They're like, oh, don't let your money go to probate. Because usually what ends up happening is it's time consuming and it's costly. So let's say like you have X amount of money and you did not have a trust and you did not have a will, then yeah, it's going to go to probate. Can you get that money? Yeah, well, over time you can, but you most likely won't get the full amount because there's a lot of charges when it comes to having it go through probate. All right. how to avoid probate. So there's a lot of ways to avoid your money being tied up and or loss. It could actually get lost in probate. So number one, name a beneficiary. Anytime you have something, like you have a home, you have a car, you have just assets in general that have value, usually you name a beneficiary or even a bank account. A beneficiary is whoever you say, hey, if I pass on, here's who I want the account or the valued good to go to. All right. The next thing is whenever you own something jointly. So let's say you have a joint bank account with a spouse. Then yeah, if you pass away, then the other person's still a signer. The other person's still a joint owner. So that way they can still have it. Same with a house. Usually like you'll hold something with survivorship rights and or jointly. Power over death, POD, payable over death or transferable on death is lingo that you can also write into whatever valued good you have. Or you could, once again, place these items in a living trust. Everything in the living trust is owned by the trust and not by the person who's died. All right, so just a little something here. Now, let's define life insurance. Life insurance is a contract between an issuer and a policyholder. So you would be the policyholder and the issuer would be whatever company owns or holds that life insurance. A life insurance policy guarantees that the insurer pays a sum of money, so every single month, to the named beneficiaries. Guarantees the company pays a sum of money to the beneficiary, so whoever you put to receive it when the insurer or policy holder dies in exchange for premiums. So monthly premiums are what's being paid every single month. So down there, I kind of define those two things once again. And if you're taking notes, this is in the notes. A beneficiary is the person or entity you name in a life insurance policy to receive the benefit. So whatever monetary benefit there is, they're going to get it. A premium, if you've ever heard of a premium, is that monthly payment, you usually monthly or sometimes annually or installment that you agree to pay a company in order to have insurance. Okay, so those are two big words that you'll hear a lot as you grow up and as you start buying insurance. Reasons why people get life insurance, there's a lot, and this is just a small list that I found. According to Investopedia.com, parents with minor children or adult children. So any single time you have parents, you have kids, it's always a good idea to get some type of life insurance in case something were to happen to you, just to make sure that they have funds for your funeral and for just life, even after you're gone. Parents with special needs, adult children who cannot take care of themselves and or who cannot work, to supplement that income, they would most likely want life insurance. Married couple or a couple with a house or some big payment that they have to pay every single month, it's always good to have a little bit of life insurance. And by the way, you can buy life insurance for whatever you want. You can buy 1 million, you can buy 10 million, you can buy any value you want. Now, obviously, the more money you pay, or the more money you ask for, the more monthly payment you're gonna have to pay. Young adults, check this out, whose parents co-signed a large loan with them. Now, this is huge. Whenever you go to college and you sign a huge loan, usually they ask for a co-signer, and usually that person would be your parents. Now, that being said, if something were to happen to you, now remember, student loans are pretty much that one loan that it's really difficult to get rid of. You can't bankrupt out of or anything like that. That being said, if something were to happen to you as a student, your parents would be liable for that loan. So just keep that in mind. And that's why life insurance is actually a pretty good idea for people who have taken out huge amounts of loans. Young adults who want to lock in low rates. So if you're super young and you want to lock in an amazing cheap rate for the rest of your life and or a term, like a period of time, then you can do that at a young age. Wealthy family who expect to owe a lot of taxes, so that could help pay for the taxes. Families who can't afford to burial or funeral expenses. Funerals are expensive, on average about $10,000. So if you have life insurance, then you're not going to have to think about how you're going to pay for this, versus you can just spend time to cope and or to grieve. Businesses with super important employees, where if they're gone, the business would go down. So that would be another example. All right. So there's a lot of examples on why people get life insurance and or why you probably will get life insurance in your life. Types of life insurances. So I just want to be clear. There's a lot out there. There's term, there's whole life, there's universal, there's variable, simplified. I've heard of all these guaranteed issue, there's group life insurance, etc. So there's a lot of different ones. The main two I hear a lot about are those top two, term and whole life. So I'm going to quickly go through this. Term insurance is usually for a specific term. So 10 years, 20 years, 25 years, or 30 years. You can even go higher than that, but the longest I've heard commonly is 30 years. So if they die while the policy is in effect, their beneficiary receives a death payout. Okay, so that's term. You lock it in for a specific amount of term. After that term's over, so let's say it's 30 years, all the money you paid in is gone, and that opportunity to get that payout is gone. So it's pretty much to get you to retirement age, if you ever think about it. Term insurance is really helpful in doing that, once you hit 60 years old or so, or 59 and a half, you can then access your 401k and other retirement accounts. So it's kind of something to get you there. Now, whole life, on the other hand, is a not term, but now this is what you call a permanent life insurance. And this stays into effect your whole entire life. So everything you pay into it, usually like there's a cash value. Now, if you take a look at the bottom there, this means that you never have to worry about uninsurability or losing your safety net as you get older. Whole life is more complicated than term because there is something called a cash value. Everything you pay into it, that is considered a cash value. Now, whole life insurance is really interesting because from what I know, it's two products in one. There's that investment-like product. So everything you pay into it, it's going to invest at a certain rate. And then it's also coupled with a life insurance policy. Okay. So once again, term versus whole life, you make a decision on what's best for you. I pulled up this from policygenius.com, but this pretty much shows you the main difference in a very easy graphic on the two different insurances. Term life insurance is usually 1 to 30 years. And once again, it's for a term. Once you're done, you're done. Whole life is for your whole life. Look at the costs. A lot of people go after term life insurance because it's cheap. $25 to $35 per month. Now, this is given on a $500,000 policy. Whoa, Mr. Chow. So you're saying if I pay $25 a month at a young age for 30 years, I can get $500,000? Yeah. And most likely what you pay into it. So if you go $25 per month times 12 months times 30 years, that does not equal $500,000. Okay. So just keep that in mind. I think I read a stat like less than 5% of people actually get the money from term insurance. But once again, it's not about getting the money. It's about ensuring that from this age to this age, you're going to be fine. Because most likely once you hit retirement age, you should have some retirement savings, etc. Whole life insurance, take a look at that. It's about 5 to 15 times more money per month than term. So it's way more expensive because once again, it's an investment account and it's an insurance account. There's a guaranteed life death benefit. Is there a guaranteed cash value? No, for term, because once again, once that term expires, you're done. But for whole life, everything you put into it has a cash value. So look more into that if you're interested. How cash value grows? No, it doesn't really grow. Now, once again, for the whole life insurance, it earns an interest at a predetermined fixed rate. So yeah, just keep that in mind. For premiums, both of them don't really change, especially for the term and whole life. From what I've heard, they're both kind of level. Now for the risks, there's not really a risk of losing your coverage. But once again, once that term ends, it's done. Versus over here, you may be able to find a better investment because I don't know the rates that are predetermined if you go back up here. And you may be able to beat that in the stock market. So once again, take a look at that. Please make a decision on what's the best for you. Now, finally, how do you obtain life insurance and how do you save it? It's pretty straightforward. So number one, you calculate how much money you need a policy for, right? So if you think about, okay, what age are you? What are your monthly expenses? How much money do you actually need for your spouse if you were to pass away? And then number two, decide the type of policy you want, term, whole life, whatever you want. And what's your age? The younger you are, the cheaper life insurance is going to be. Every year makes a difference. So if you buy it at like 20 years old, it is cheap. If you buy it at 30 or 40, it's going to be like way more, right? So I'll show you the numbers in a bit. Number three, prepare all your personal identification documents for Shop It. And during the fifth video, I'm going to talk about how can you save money when it comes to buying insurance. And once again, you can get insurance through any company that sells it. And then five, complete a life insurance medical exam. Okay. Now, you can't just buy $1 million policy and, like if you know that you're going to pass away soon, right? They're going to charge you way more because usually they do something called a medical exam. It's kind of like a blood test. Weight, body mass index, your BMI. Like they look at whether or not you smoked or not, and they do a bunch of these other tests to see in your family history and stuff like that, to kind of calculate what are what are the chances that you're going to pass away in the next whatever years, 10, 20, 30 years. Then you sign your documents and then you keep making your payment every single month and you're done. Now, to go back on number 4, personally, I don't mind paying a little more. So this is my philosophy here. If I can get a reputable, long-lasting company. All these new companies that are popping up that will charge you like way less. They're like, oh, like we'll sell you this. You don't know how long they're going to last. And sure, there's things in place to make sure that they don't scam you. But once again, you do your due diligence on the company before you actually buy it. If you take a look at life insurance here, for men, it's cheaper than women. That's just what it is. Sorry, men is more expensive than women. I'm sorry. That's a typo up there. More expensive than women. So to insure a man is way more expensive because men are more likely to pass away, right? Versus women, right? So that's just a stat. And then take a look at this. The younger you are, the healthier you are, the cheaper it's going to be. Going back to that test, okay, that medical exam. When you're done with the medical exam, like they'll tell you if you're super preferred, standard, or less. So there's different categories per different insurance company, and they'll kind of rank you in a certain category. Take a look. If you're 30 years old and you're super preferred, which is you're super healthy, it's $228 per month. Per year, I think. I think this is annually. Yep, annual. So it's $228 per year for 20 years for $500,000. Look at the same thing if you're 50 years old and you're standard. It's $1,500 for the same policy. That is like 7-8 times more. So as you can see here, the younger you are and the more healthy you are, the better. All right, so keep that in mind. Finally, so we're done. So day 4 is going to be all about property insurance, and day 5 is going to be about how you can get the best deal. Thank you everybody for watching this video. And I really hope that these videos have been super informative and super educational for you. All right, until next time, bye.